Tell me, Gordon, when does it all end, huh? How many yachts can you water ski behind? How much is enough?
It's not a question of enough, pal. It's a zero-sum game. Somebody wins, somebody loses. Money itself isn't lost or made. It's simply transferred from one perception to another. Like magic. This painting here, I bought it 10 years ago for $60,000. I could sell it today for $600. The illusion has become real. And the more real it becomes, the more desperate they want it. Capitalism at its finest.
Welcome back, fellas. Here we are at the end of another week, ready for another weekly market recap. A little bit of a more volatile week compared to the past two, I guess, both for markets and from a price action standpoint, and for me personally. But mine is a little bit more of a misfortune, I guess. Basically, I'm taking antibiotics now because I got the starting of a little bit of a otitis. I think it's the medical term, but basically a ear infection. So, you know, if my voice is a little bit fucked up, it's because when I take meds, I usually get my sleep cycle fucked, and then, you know, my voice is like that in the morning. But beside that, and beside my personal these adventures, let's start out with the video. And the good news is that this week, the economic calendar was very, very light. Actually, as I said last week, nothing interesting for me, if not, I guess, what was that, PMI, but that was global, so not even going to bother to look at them. So let's start out with the charts instead, all right? So let's have a look at the DXY, which still doing the same, right? It's moving slowly, sure, but we are still observing that we broke out of this level of resistance here, and we are now using it as a support and resistance flip. So same old story. It took a while to kind of confirm it, but you know, considering that we have a deeper push down into it, a deeper test, and we have a good reaction off of it, we took out the high, right, which was responsible for the initiation of this deeper test in the previous area of resistance, which seems to be confirmed as a support and resistance flip now. Obviously, sure, you need continuation after this push higher, right? Because, you know, in the end, if we keep on stalling at these highs right in here, right, the possibility for a continuing ranging behavior are still there. But nonetheless, for now, if we take a picture of this exact moment in the market, it looks a little bit like that, right? Which, you know, it's not a surprise, I guess, because, you know, we are going to talk about it later, but I think is tied a little bit to what's happening in the oil market. Again, as I said, like 1 month ago or something like that, I think at the end of the day, everything is connected. Gold, yields, oil, the dollar, right? The system is all interconnected. Conversely, other currencies, as you would expect, like the euro was down, the pound, after that huge bounce that we were highlighting, and that divergence, that, you know, relative strength divergence in between the pound and the euro, we've seen the pound coming all the way back down, right? So, you know, at the end of the day, yeah, temporary breaking correlation, but the direction seems to be the same yet. What else? The Japanese yen, as you can see, 163 now. I think at this point, there's very little to hold this thing right here. Like, I mean, I don't know if you're going to be able to see it, but if you go on a monthly time scale, look at that. So we were seeing throughout, you know, the early 2000s, the yen going up. Then you got what? This point right here, we broke these long-term diagonal to the upside. And bear in mind, this is a monthly chart, right? Then we retested it, and we kept on drifting down ever since. And now we are breaking what? We are breaking this important level established in the 90s, whether you believe it or not. And it looks like, you know, we bounced off of it. And then, you know, we are now starting to crack it. And what we got below, well, a very inefficient leg, as you can see. And there's really no real support up until the point you get into the in day 200s, right? So You know, I mean, you could argue maybe a pound around here, around like 180, but realistically, it looks to me like the bulk of the volume wouldn't show up until the 200. But again, bear in mind, monthly chart, so it could take another few months to unfold itself. But, you know, on a daily time frame, you see that the momentum, it's still to the downside, all right? Now, it seems crazy to say, you know, the yen is going to get back to 200, right? And what's going to happen to Japan at that point? I mean, if you think they are in crisis mode with these tiny little thing going past 160, and it looks like their own central bank, the BOJ, actually drew the line at 160. Look at how many interventions you got around that level. Now that they lost it, what are they going to do, right? So, you know, I guess never say never in markets, but, you know, nobody thought it was possible, but it looks like it is happening, or it's starting to happen. So, you know, watch out for that, because it has massive implications for a lot of many other different things, all right? Then what? Canadian dollar, we got the pullback, that bounce. It looks like it's kind of faded right at that level we were looking at, kind of here. I mean, it's not a definitive fade. Like, we could still draw back the leg a bit more from here, but as soon as we collapse back below this kind of a structure right in here, right? As soon as you start to crack this level once again, it's game on to the downside, I guess, all right? Swiss franc is still drifting down. We broke this type of a diagonal even in here. So this trend line, which was there, it was kind of like this, I do believe, right? It's not really exact, but you can kind of see, right? The momentum to the upside was like this. Then we cracked it, kind of retested the same area, and then we were rejected. So same logic there, all right? Other currencies, what do they do? Looks to me like at the end of the day, the South African rand, it kind of broke that ascending triangle to the downside though. So even in this one, maybe the dollar wrecking ball is starting to hit again. Brazilian real still relatively stable in my view, right? It's still the best chart of the pack. Russian ruble, I mean, it collapsed back down, but still just got back into these tiny little dealing range in here, bounced, faded, but still there. So for now, I would be, obviously after the rejection in here, a bit more bearish oriented, but, you know, very short term, it could keep on going sideways for another week, maybe, who knows, right? And, you know, the bullish case starting to make new high and trying to fill in this leg to the downside, right? But for now, don't have a strong opinion on that. The Australian dollar, same, not having a strong opinion. I think we are still range bound with this one. I think what's saving it, it's that, you know, kind of like the Canadian dollar, but to a much, you know, bigger degree. The Australian dollar, it's a commodity currency, right? So if you see commodities going up because of supply chain disruptions or, you know, problems with logistics and whatever, right? You know, since they are exporting a lot of commodities, you may see the currency benefiting a bit from that, because in order to buy the commodities from Australia, you would need to do what first? But to swap your local currency in Australian dollar, because those commodities are priced in Australian dollar. So it could be something like that. Obviously, you know, even if you assume that, you would need to consider that in case you see a global slowdown from an economic standpoint, demand for every commodity from, you know, copper or steel, iron, or whatever, it would go down, and therefore maybe the demand for Australian dollars would go down with it. So, you know, I think it's very influenced by, you know, the business cycle, the economic cycle, and all the rest, right? But, you know, that's more of a macro topic. For now, I think it's just going sideways. There's no huge move to highlight in this one, which instead you have what something resembling another big move brewing in the Indian rupee, which again, It bounced for a few weeks, and then what? And then it's collapsing again. So, same old story, kind of like the yen. These two charts, the yen and the Indian rupee, has always been the most bearish charts in my deck as for currencies. Instead, the Chinese yuan still holding relatively well. Like if you zoom out, kind of like we did on the yen, and you go on a monthly time frame, look at that, right? Now, you might say, well, that's good for China. Is it that good for China? I don't know. I mean, if you assume that China could now buy raw materials or energy at a much more convenient price because their currency it's strengthening against the dollar and the majority of the commodities are priced in dollars, yeah, sure. But on the other side of things, you would also need to consider that they are an exporting nation, so they base their economy in building up the most possible goods and then exporting them at a cheaper price compared to their competitors. So, if their currency is appreciating against all the others, and I mean, I guess you can kind of tell because they are going up against the US dollar, right? And the US dollar is going up against pretty much everything else, at least, the G7 economies, right? That makes their goods a little bit less convenient to acquire or to purchase, right? So, there is always two sides of the coin when you see a currency moving, all right? Now, personally, I don't think that it's going to make a huge difference in the near term. But from a macro standpoint, if it keeps on going for a while, right, it may be a problem for China, and maybe they would try again to devalue the yuan just to boost their exports. I don't think we're there yet, but again, try to apply the same thought experiment as for the Australian dollar, right? Let's say you have a global slowdown, demand goes down globally, and since they are an exporting nation, if global demand is going down, they're going to see what? They're going to see the surplus. They're going to be unable to unload their production surplus on the rest of the world, right? And what's going to happen? It's going to implode their economic model, which would bring to what? Well, lower employment, and since they got a good chunk of debt / leverage in their own local economy, if they don't have capital flows moving in, it would be harder to service that debt and rolling that over, right? Not to mention the problem that they got in the real estate market. They basically have a bubble which just burst. So, I mean, it's nice. It's all cool to look at the US and all the Western civilization and then say, yeah, I mean, we got a lot of problems. I mean, the rest of the world have problems too. So we are not alone, right? It's something which is common to pretty much everyone at this point, right? Now, enough currencies. Let's have a look instead at Bitcoin, which behaved kind of cool, especially in the beginning of the week, right? Monday, there was this week to the downside and then immediately absorbed. We finally made the high above this level, right? And we almost tested the key swing high in here, all right? Now, sure, as you can see, I drew these two dotted diagonals in here, which is basically the price action drifting up, right, for now. So you may say, okay, we got, although it's very sloppy, very dirty, very, ebbing and flowing, right? But we still have some sort of an upside momentum up until the point we don't break it, right? And, at the same time, you may say, okay, so that was a key high, right? And that was a key low or a double bottom, a double swing, whatever. At the end of the day, up until the point you are below that key high, right, but above those key lows, you're still good to be in a ranging environment. And it's a very wide range, basically 67,000 down to 58. So, a good 9K of range. But nonetheless, always account for the volatility of the asset. So, it looks constructive, yet although it's very near to break that, constructive behavior, so to speak, and just getting back to that boring, noisy, choppy behavior that you usually get in a ranging environment. In other news, if you want to tie the fate of Bitcoin to, I don't know, MicroStrategy, MicroStrategy, it's not really trading well. And even if you look at the preferred, right, the stretch, it's been a while now since we got that move below par. But we recovered a bit of that, but we are still, 86, so 14 basis points below par for what should be a money market fund at the end of the day, or it should act like a bond or a treasury, whatever. So it would need to trade at par, right? And it's not. And it looks like, obviously it's too early to tell, right? Even for me, I would say it's too early to tell. But it looks like it went down, it bounced, and now it's drifting back down. As you see, lower highs, kind of lower lows, at least, 2 lower lows, right? And these. So, can they still save it? Yeah, absolutely. Saylor has billions in Bitcoin to be liquidated in order to sustain this tiny little thing. What would that do to the Bitcoin market if we actually go and do it? It would put downward pressure on Bitcoin. But again, I don't ever be so quick in calling those stuff, right? You don't know at what point these guys are going to be forced to do that. They may have to, they may not. They could be forced to do it in a month or maybe in 2 years. But, it's one of those things where you do know the risk is there, but just because you see a risk, it doesn't mean that it's going to unfold right here, right now, okay? Just, every once in a while, if you're interested in the Bitcoin market, just check these two charts, right? Both MicroStrategy and Stretch, just for the sake of completeness, right? So you don't get blindsided and caught off guard, right? So, other than that, Bitcoin for now, I would say up until the point it can maintain these higher highs, higher low structure, still good. If you start to lose it, you shift back from, kind of bullish back to neutral. But, the problem is that neutral, in this case, it would be, kind of like maintaining the status quo, which is what? Down leg, a few weeks or months of sideways, choppy, silly action, and then another down leg. A few weeks and months of silly, stupid, choppy actions, and then what? Down leg. So is it going to be the same story again? So, neutral in this case, it's a little bit more of the same, which eventually should lead to continuation. So call it neutral, very short term, but, if it gets protracted for, a bit of time, it could, very easily get back to be bearish, right? Just because the trend is down currently, right? From the highs, the trend is down, right? So, just for the sake of it, okay? Then what? Let's have a look at what gold did. And again, 4,000 level, held again last week. You remember another very good bounce, and we have been faded again for another what? I think, if you just look at the structure of the market, this is another lower high, right? A high in here, and this is a lower high. So, still, the trend is down. There's no other way around it. And, it may take a while to chew through that very psychological level at 4,000, but, up until the point something really changes in here, we may need to see a very sharp move to the upside on volumes, right? So conviction on the side of the market, especially on the side of the buyers. I would still think we have space to come back down, maybe slowly, maybe choppy, maybe, drifting down and not completely dumping, but, 3,800, 3,600, something like that. I think we are still on the go to hit those targets. I don't know why, and I don't know when, but, the structure is just bearish for me. So it would make sense to keep on looking for those areas to be tested. And again, if you do believe in gold long term, I guess when you start to crack the 3,800, right? From there, basically to 3,400, though it's a good area to start to build up a position long term, if you believe in it, all right? And again, there are narratives for it, right? Like China, the gold-backed new monetary system they are trying to build up, right? Or the fact that now gold, it represents a much bigger percentage in the global reserves compared to the dollar, although there's always that price mechanism, right? Yeah, gold went up a lot in price. Treasuries, of course, went down a lot in price. So, is it just a price illusion or what? But again, still, at a point, if the narrative sticks, right? That's the perverse mechanism of markets, right? Up until a point, it doesn't really matter if something is true or not. What matters if people actually believe in it enough or not. Then again, of course, down the road, months, years, who knows, at a point, what's true and what's not, it's going to matter. But narratives can stick for a very long time before they are defeated, right? So it's a game of balancing out your ability to keep on riding a narrative, but keep on being aware that it's just a narrative. And the moment it fades, everything's shattered, right? So, just try to always walk that very tight razor rope, right? The other metals, what do they do? Oh, well, not a lot. I mean, if you look at silver, for instance, it looks like we broke this level right here, and we tried to retest it, were rejected. And this week, again, tried again to bounce in it, rejection for now. And it's kind of the same in the others, right? If you look at platinum in here, we kind of broke this support in here, and now we're living below it. Same for palladium. It's pretty clear in here. Like you got support, broken, retested. Now confirm that's what? Resistance. So up until the point we are living below these levels on these three charts, can't be, bullish, no short term, no medium term, the other side of the story instead is copper. Again, we were talking about it. I mean, copper came all the way back down into here, bounced, started to drift higher. We were rejected initially at this point of release in here, but again, higher highs, higher lows. So we are still cracking highs and defending lows. So it's hard to be bearish on copper. Structurally, it's a very good market. Might be a little bit volatile. It might be a little bit scary, but it's a market which is still going up. And again, the narrative is there. The fundamental thesis is there. We are still seeing hyperscalers building up the AI infrastructure. So you need a lot of copper. So, it's really hard to be bearish on copper. At the same time, I think if you are trading it, I think it's hard as well to always try to trade it on the long side, because as you can see, especially recently, right, it's very volatile, right? So just because you think the structure and the long-term, trend is up, it's to the upside, right? I mean, not every single day, if you're trying to day trade it, you're going to be lucky just trading on the long side. It's not like an index, right? When you see the Nasdaq or the S&P actually being in a bull market, it's kind of safe to say that, 7 days out of 10, right? You're going to be good just trying to buy the dip, even intraday, and so be it. Copper seems to be a little bit different. So, if you are trading it actively, I would suggest caution, right? And pay very good attention at the structure of the market, right? So, crude oil. Well, looks like we are finally there, back in the 90s. Now, if you remember, right, I think it's, basically a month ago. Let me check. I was in here. If you remember this video right here, all right? So, 1 month ago, basically. If you go, I guess, past the first 30 minutes, So in the oil section of this video, I was basically highlighting all the reasons why, up until the point we were in here, I was, confident enough the market would have dropped back. All right, okay. And then when we were in here, although, sure, the market actually went a bit more down, right? It went a bit lower from 73, it got to 69, 68. We completely filled this gap right here. It was in the cards. But, if you remember, or if you have the time to go back and watch it, the thing was, okay, but after all this swing gets completed, I don't know, because there are a lot of things to consider. And, I'm not gonna, repeat them all, but the bottom line is, if you believe those kind of problems are not completely sorted out and the market will look through it and decided that, you know what, we are not out of the woods yet. I remember I said, look, I'm not saying we're going to shoot back higher to 120 right away, but maybe in the 90s, right? And it looks like we closed the week at 90 and a half, basically. So, obviously what happened in the oil market, it's a result of what's going on with the conflict in the Middle East, which seems to be re-escalation after re-escalation. What was that sentence that I heard from an American official? Because the Iranians went like, okay, it's going to be an eye for an eye. And the other responded, no, it's going to be a head for an eye. So, if you escalate, I need to over-escalate you. I don't know how it's going to end up. And quite honestly, if you look at whatever podcast or geopolitical analyst or military strategist, they're all going to have different opinions at this point. Kind of like in markets, right? So I don't know who's going to win. And at this point, I don't even know what winning actually means, right? It depends on who you ask, right? Like, again, if you ask the Iranians, I guess winning it's just enduring and preserving the regime. If you're asking the Americans, I don't know, winning would be what? Regaining control of the Strait of Hormuz, reopening it, convincing Iran to give up on the nuclear program. But who knows, right? So all I know is that at a point the market would need to worry about this oil thing. Like, we know that SPRs, so strategic petroleum reserves, they were very depleted in the first stages of the war and the initial spike, right? So now we are very low on reserves. And, seeing the conflict reigniting like this, it may be a problem for the oil market, right? In the sense that, okay, first time, we got a lot of reserves. Then again, China actually helped a lot because they didn't start to refill their own reserves right away after the first ceasefire. So they kind of held demand down by basically giving up the incredible amount of demand on a daily basis, right? So they helped taming price down. But, at a point, especially when you go to the end of the summer and you start to think about the fall and then the winter, there's going to be one nation here and there which is going to start to think, wait, okay, I didn't bid it because I thought, well, the crisis will resolve itself. But now I'm really facing, this window of opportunity closing in because I need to refill my reserves, both of oil, gas, nat gas, LNG, whatever. So, it may be a good problem. Now, sure, there is always the other side of the coin, which again is what? Demand destruction, all right? And I would also say, I don't have it right here, but if you look at the positioning, right? Maybe with the volumes, we can see that. No, not really, especially because this is the future. But wait, if I use the ETF instead, let's use this one. Let's try with this one. It's kind of there, but not really. But again, it could be. It's not really representative of the positioning, but just, at a very base level, right? You've seen the spike when the war started. And where do you see the majority of the volumes being put in? In here, right? So it looks like people started to pile in while the market was going up. And then the volumes actually decreased while the market was still going higher, right? So less people, less participation, right? Then the market went all the way down. But look at the volumes. There is no volume, right? So what does it mean? Well, either this move down was not really participated in the sense that there wasn't a lot of selling, right? It was just demand evaporating. And then what? But maybe those people, instead of selling, they just hedged, right? I mean, I got positions in here. You know what? I'm going to hedge those positions because I think maybe the drawback will be temporary. I'm still faithful to my thesis about oil going to 200. So I'm going to hedge my bets in here. And so when it goes down, it's just nobody bidding it. Demand evaporates temporarily. People which bought before just hedged. And now you see price going back up with no volumes again. So it's this sharp move to the upside. Just those people, closing down their edges. It could be. But in that case, right, two things. Either, you'll see the 90s providing a good level of resistance and we are kind of going to trade in a range, right? Or that leaves the door open for a hell of a lot more people to actually start bidding. And you're going to probably see, if we start to crack this region right here, a volume spike. If there are more people getting in now, right? So that's kind of the risk to the upside in this case, at least in my view. But, it's hard to confirm if you don't really track the positioning, right? I was just thinking about this dynamic because at least from a volumetric standpoint, it's not really confirming it. As you know, I genuinely move down and then I genuinely move up. It wasn't participated a lot. But, I was looking at a few charts on independent websites about positioning in oil, and it looks like there wasn't a lot of change in positioning. If anything, there were a hell of a lot more longs building up in here throughout the initial stages rather than here. And it's kind of, again, counterintuitive. Although people are buying the initial spike, you could also think, okay, they needed to give up because they basically bought around the top. And then they've seen the thesis kind of not playing out immediately. And now that maybe it's the time with the SPR completely depleted, where that initial thesis in here will play out. They're not buying it because they got burned the first time, right? That's another risk. But then, if they see it actually going now, they're going to need, again, ironically, to pile in right near the highs, again, at a very disadvantageous price. So we'll see how it ends up. I don't know, honestly. I'm not a military expert. I'm not a geopolitical expert. I just think at the end of the day, for what concerns us as traders and, as speculators or maybe even investors, I still think, if you look at the curve, I mean, yeah, it went up a little bit, but, if you look down the road for December, it's pricing in 80, end of Q1, 2027, 75. So, I mean, the oil market, as for the futures, still pricing oil to be relatively tamed next year. And again, what may be the reason of that? I don't know. They're not explaining it. That they're just showing you what they're doing with the money. All right. I could make hypotheses. Obviously, that implies the conflict is going to end one way or the other. One side will need to cave in. We don't know who it's going to be. Right? You could build up a good argument for both, right? Both would have reasons to cave in and to surrender. Iran, obviously, for practical reasons, like they may be annihilated, who knows? Or maybe there will be finally that insurgency internally, domestically, that a lot of people are asking for. And on the other side, the US, if you break their political willingness of keep on waging war, yeah, they will need to cave in. Or if we get to November, midterms, right? And Trump loses, and then Congress may not agree to keep on the war effort. Although, constitutionally, there are a lot of caveats there. But the president have a lot of ways to kind of try to overthrow Congress decision, even in that case, emergency powers and all the rest. But again, it could become messy, right? So both sides would have a point. There is always a tipping point where the convenience of keeping on the war effort, it's not matching up with the expected benefits or results. So, at a point, someone will have to cave in. And that's what the oil market is pricing in as for the futures, but it's not telling you how they think the thing will actually end, right? As for now, obviously, if you think about these two levels right here, right? So it's normal to see this tiny little bit of rejection at this point of release, although we kind of use that former base, these last apex below the drop down. At the very least for now, we'll see next week. It's, again, don't judge it by just one candle, but, it was kind of a support. Let's zoom in just to see that. I mean, we bounced in here, then we bounced again, then we broke the area, went all the way back down. And then we came back in it, initial rejection on a 4 hour. And then that daily point of release in here, rejection in here. But now we are using the same level as a level of support. You could almost call it a reclaim, right, of a level which was support, broken, initial test, rejection, back in it, breakthrough, and then retest from the upside from above now and using it as support. So a support which was before now reclaimed. In that case, it would be the bullish case, right? So, it's a very tough market, I guess. And as I said in that video, I pointed out, I was kind of confident in my thesis when we were in here and I was expecting the drop. I started to have doubts that maybe a bounce into the 90s could have been in the cards. And now I really don't know. Now it's really the time where instead of having biases and war, I just prefer to look at these things day by day, candle by candle, because I honestly don't have a thesis where I would feel confident enough to say, yeah, I would bet on it rather than the other, right? So I know it's not very helpful, but that would be it for me at this point, right? So very tied with the oil market is, of course, what? Well, inflation expectations, right? So let's check that out. I mean, as you can see, the break-evens, they barely moved this week. So, not a lot. Let's try to zoom in a tiny bit, but I think it's the same. Kind of sideways again. So this is another data. There's another piece of data which would confirm what you see in the futures curve, which is, yeah, I mean, if they are pricing in this inflation, and the curve is pricing in lower oil prices into the future next year or after Q1, Q2, all right? I mean, what do you think is going to be? Two things, right? Either the conflict is going to end one way or the other, and oil prices will be back down because of supply not being constrained anymore, right? Strait of Hormuz open, whether the Americans actually gain control of it or they leave the control to the Iranians and they accept that they're going to impose the toll, the fees, whatever, right? But oil will start to flow back, right? Or the other case, which is, I don't know if it's better or worse, but it's basically demand destruction. There's not going to be inflation because globally, the economy will be destroyed by this oil spike. And you may say, okay, demand for oil is inelastic, sure, but you could have oil going to 200. What do you think is going to happen to all the rest? All the money would need to be spent on oil and gas and LNG. You're going to kill the rest of discretionary spending. And therefore, you're going to kill what? The economy. And you're going to kill jobs. You're going to kill payrolls. It's hard to have an inflationary environment if people are losing their houses, their job, they cannot spend anymore, right? Who's going to beat those prices higher? or even if they can kind of maintaining their jobs, but if you are making $2,000 per month, just fantasy numbers here, and your electricity bill is now $300 per month. Okay, let's say it goes up to $1,000. Are you gonna stop paying it? No. You're gonna stop spending on other stuff, and you're gonna spend those money on the electricity bill because you need that more than anything else. So that's the demand destruction I'm talking about. The CME Fed Watch tool, it rebounded a little bit. It might be because of oil coming back up. So the odds for a hike came back up to 34%. We'll see. I think next FOMC is next week, probably 28, 29. Don't remember for sure, but in the middle of next week. I'm still thinking they're not going to hike, but we'll see. It's a new Fed chair, so I guess at least if it doesn't hike, it's going to try to be as hawkish as it can be. But I don't know. I don't see a hike. I could be wrong, right? Many different times in the past I've been wrong. Who knows? But it's just I keep on thinking. If you look at the incentive structure, right? And if you assume just for a moment that at the end of the day, both Powell before and Kevin Walsh now, they are not complete stupid or idiots, right? They must know that it doesn't make a difference whether they hike 25 basis points or not. It's not going to make oil flowing out of the Strait of Hormuz faster or slower if they decide to hike or not. But what they would do, they would put even more pressure of an economy which is already suffering, for, gas at the pump being higher and whatnot. So I don't really see a reason for hiking rates. I don't think that's a lever that you can pull in order to change the balance in this whole thing, right? So we'll see about that, okay? Now, with oil, with inflation expectations, of course, you have also movements in the yields. And of course, since oil went all the way back up from the 70s into the 90s, yields reflected that by going higher. So you see the short end right in here, it's really moving up now. Even, the 10-year at this point made a high. The long bond or the long yield, not yet. It's particularly close, but not yet. So again, if you look at the curve, what you see is that we are flattening once again. Which again, it's still paired up, right, with what you've seen in the break-evens, the tips, and what you've seen in the oil future contract curve. If this thing is kind of going back toward inversion, what does it mean? It means that short-term rates are going up faster than medium to long-term, which again essentially means, maybe inflation in the near term or inflation risk in the near term, but long-term, even the bond market doesn't see it, right? And if you zoom out, it was a little bit like that, even back in 2022. Why do you think they inverted the curve or the curve inverted? I mean, the Fed actually brought rates higher and higher and higher, the fastest hiking campaign in history. And the bond market started to say, you know what, at this point, we not believe that. And in fact, at the end of the day, CPI peaked at around 9%, and it came all the way back down to 3, 2.6, whatever it was. So this is just a signal. It doesn't have to play out exactly, or it doesn't have to play out in that time span, very quick time span you would expect, but it's still the bond market signaling you what they do think is going to happen. And you gotta consider they really have boots on the ground, so to speak. And no pun, but boots on the ground. Boots on the ground. It's what may be fueling this move to the upside in oil, because it's something which has been discussed recently as a military option in this USA-Iran conflict, right? So, but, sticking to the yields, I think at the end of the day, they are very closely correlated to oil because it's natural that if energy goes up in price, everything else down the supply chain will go up in price. So you would expect inflation to go up. The problem is always like, is it a temporary situation or is it a sustainable and permanent situation? So again, I think there's always a little bit of that. If you look, for instance, at this forecast, I think this should be Goldman Sachs, if I'm not mistaken. Yeah, they have, these 3 cases in which the oil price should have come all the way back down, but it looks like we kind of have, at least, starting from July, so basically where we are right now, right, after the drop back into the, 60 and 70, we had price going all the way back up, right? It dropped, of course, and then, the forecast was, well, unless we have more Hormuz disruption, we should see oil coming back down. Well, it looks like we are having more Hormuz disruption. Therefore, they are forecasting prices to get all the way back up to 120, 126. So are we in that environment right now? And therefore, yields should reflect that, right? So guess we'll see about that. Totally possible. I mean, at this point, everything is on the table. So yeah, get ready for it. All right. Now, after all these, right, which was kind of enough trying to link all these different markets, yields, oil, again, and then if you think oil, look, just, since I was talking about linking them all up, oil goes up, sure. Yields, what do? They reflect it. They went up. And so what bonds did? They went down. Because of what? Because if you think oil is going up and it's going to keep on going up and oil is priced in dollars, what you're going to do? You're going to sell your reserves to acquire what? Dollars to buy oil at a much higher price in dollar terms. So you're dumping your reserves, the treasuries, yields are spiking, and at the same time, the dollar is going up. Because people need more dollar, or they think they want to acquire more dollars now because they will need more dollars to pay more for a commodity which they desperately need, and it's going up in price and it's priced in dollars, right? So this is how everything kind of may be, be linked up together. And when you think about selling the reserves, that's a reserve too, especially if over the recent years, right? It went up so much. It's even more convenient to sell it now and to using it as a source of liquidity. Because at the end of the day, you could say what you want, but it doesn't matter how much gold you have in your vault. If you don't have oil, you're fucked anyway. You're not going to produce energy with gold. You're not going to produce plastic materials or all the different things the industry needs without oil and with gold. And so, it doesn't matter how much gold you have. It's like, think about that. If all of a sudden there is a problem with the global water supply, wouldn't you sell every asset you have in order to get that water? You can't survive without water, right? Now, economically speaking, oil, it's kind of like the same. I mean, as a human being, you can survive without oil, like organically. You're not in need to have an intake of oil, like water. But the economic system actually needs oil for basically everything, from energy to industrial production, right? So people are going to sell whatever they got in order to acquire the oil. Because whether you like it or not, our system globally still runs on oil. You may like Greta Thunberg, you may like climate change, you may like renewables. Sure, maybe 20 years down the road, you're going to give up oil. For now, we are very much oil dependent globally, right? So after that, let's have a brief pause and then we will come back to have a look at what happened in the stock market this week. And as I promised, I will try to bring back that theme, that tiny little segment I wanted to include last week, but didn't have time for, right? let's start to have a look at the equity market by just looking at the price action, all right? So you see both NQ futures and ES mini futures, right? I mean, you don't need a genius to tell this week was a bearish week, obviously, right? Because you see we opened up the week, right? We immediately tested back into the weekly open, both for ES and NQ in here on Monday, right? And I mean, the good thing was that at the very least, we defended the lows put in on a previous Friday, right? And we rallied all the way to the upside throughout Tuesday, Wednesday. And then, yeah, again, as Tico pointed out, I repeated that constantly in the videos, I guess, Thursday reversal, right? And look at the impulsive move to the downside on Thursday, all right? Kind of started in Asia. The London session was a little bit choppy and then a washout, very good flush to the downside throughout the American session. And, you know, it happened on Thursday. Now, if you remember, back when the market was drifting down, right, which was basically in here, right, in here, before the huge run up in the April lows. Even in this context right here, the majority of the huge days to the downside were either Wednesdays or Thursdays. Usually the week was starting out with Monday, Tuesday kind of trying to push higher and bouncing. And then midweek, you got the reversal and therefore the market was bleeding down. Okay. So is it the end of the world? Probably not the end of the world, but nonetheless, I mean, it was bearish. And even on a very smaller scale like this, you can see that the Nasdaq is a hell of a lot weaker. Like, even like the way they closed the week, just think about, you know, Friday alone. Look at what happened, you know, on Friday. The S&P actually tried to bounce, made new highs, relatively speaking, to these, you know, intraday price action. The Nasdaq never got back up above the Asian highs for Friday. And then it closed on new lows for the day. Well, at least the S&P defended Thursday's lows. Does it mean the S&P is going to rally next week? I don't know. But it just means if you just look at the break in the structure in here and structure being held in here, it's relative weakness in the Nasdaq. And you know, again, we've been talking about it for weeks now. As soon as you zoom out, you remember, it was looking a bit more constructive on the S&P, a little bit more bearish on the Nasdaq. Now the entire structure for pretty much everything across the board, it's starting to break, I would say. But again, it's just one candle on a Friday, so just don't be, you know, don't be too quick in judging it. But sure, the price action, it's not developing well for the bulls in this case. And even, you know, remember the Dow was moving up in this type of a channel right here. Another testing it, tiny bounce, and it looks like we broke it and kind of already retested it, and you know, so far being kind of rejected. NQ on the daily was some sort of a descending triangle. Looks like we tried and managed to break, at least on a closing base, right? And the S&P, again, it was looking like reaccumulation, but then, you know, we want to use a closing base on this one as well, and then it would be kind of like that, I guess. Yeah. So, you know, it's a breakout, or in this case, a breakdown, right? Now, again, we are almost in August, so timing seems kind of good, in the sense that I was putting the majority of the risk for much farther downside on August, September. Obviously, what's going on in the Middle East and what's going on with oil, and consequently with yields, it could be a good catalyst for a correction. And, you know, you would need to start to think about targets now. I mean, if this is really the beginning of a much deeper correction, where are we going to go? right? So we need to zoom out a bit. Let's have a look at these first, right? Maybe just really zooming out on a weekly time frame. Where do you think we're going to go, right? If we keep on correcting, I would say previous all-time highs. It's not that far-fetched, right? Both for the Qs and potentially for the spiders, right? Which, you know, if you get back into here, would put you where? Kind of like in line with the 200 days moving average. And considering, you know, if you zoom out, right? It's an average, right? So even in a bull market, look at that. Think of 2023. 2024, where the market was really going up. Look how many times the market went all the way back up, and then it corrected, and it got back toward what? The 200 days moving average. Even last August, I mean, not really last August, I think throughout that carry trade debacle in August 2024, look where we got. That 200 days moving average. Then again, when the market got really scared because of tariffs, we broke it, we tested it using at what? Resistance now, and we went down farther. And where, you know, when did the kind of the thing actually shifted? When we reclaimed it, right? Then again, we stayed deviated from that long-term average for quite a bit of time in here, right? Both in here. And then we mean reverted back to what? That same moving average. We traded a bit below it, and as soon as we reclaimed that with this very impulsive candle in here, which completely negated this whole attempt to break lower and having continuation lower, we were off with the races. So again, is it so far-fetched to think that if things keep on developing badly in the Middle East, if inflation expectations and you know, as reflected by yields at the very least, which I'm going to stress that out once again. Tips are telling you something. Yields are telling you another story, but yields are also a reflection of what you have to sell in terms of your treasuries to afford what? To afford to buy oil at higher prices, right? So just try to put a differentiating line in what you're picking up from the bond market, from the yields on treasuries and from tips, right? They are moving in different direction because they are responding to different dynamics, in my view, right? So, you know, just for the sake of completeness, I guess. So, you know, all in all, if this is going to be a much prolonged type of pullback or correction, yeah, I mean, I would keep an eye on that 200 days moving average and see how the market reacts there. Because, you know, it could be a good point to maybe try to reaccumulate, right? It might be choppy and sloppy around it for a while, you know, and then, you know, the market may try to build back a base in here. And, you know, fast forward to October, November, midterms are behind us. We get to the more, you know, to the much stronger period of the year as for seasonality, and you might have a little bit of a rally in year end. Who knows, right? But for now, absolutely, the risk is there. We have been talking about this risk throughout the summer, starting in the spring. So now don't be surprised if you see that risk being materialized. And remember, when we started to talk about it, back then, we didn't have talking about boots on the ground or re-escalation or whatever. It was just a normal forecast based on seasonality, based on the fact that this market went too fast and too far, too quick, right? And because at the end of the day, mean reversion, it's the most powerful thing in financial markets, right? Now again, beyond the war or re-escalation of the war, this week, we also had something else. We got earnings. And if you check Alphabet, well, basically Google, right? It's kind of the same in Tesla, but I guess Google is the case of study here. They had very good revenues, very good EPS, earnings per share, right? And you might call it stellar results, right? They increased, like I was reading, they increased the cloud revenues by 82% year over year. So monster numbers, right? But then again, if you then go and check what the stock did this week, it's massively down. Same with Tesla, right? Same with Microsoft to a lesser degree, but look at Meta, right? Or even Amazon. Apple is a little bit of an outlier for now. And I'm going to get back to Apple a little bit less down the road, because I think, again, although a lot of people hate him, they are kind of smart in a sense, all right? So why do you see all the Mac 7 actually being down? I mean, this week, even semiconductors were down, right? I think if you remember about semiconductors, yeah, I mean, is it playing out slowly? Yeah, maybe sloppy a bit, but is it playing out? We'll see. Again, I told you it's gonna take time. It's a daily time frame, right? But SMH was looking like a head and shoulder, was looking like was losing momentum. We would have a very good target for the the pattern lining up with the 618 retracement from the last swing high. So who knows, right? Just things to consider and to keep on monitoring, right? But getting back to Google and to the earnings and whatever, I think if you look at the hyperscalers now, the market is kind of sniffing that, sure, I mean, revenues are good, all right? And earnings are good. No questions about that. Why those stocks are so heavily punished then? Now, one of the problems, maybe this one, their CapEx estimates. So, I mean, I honestly don't think I need to explain to you what free cash flow is, right? But basically, a company makes money, company pays taxes, expenses, whatever, payrolls, and then you have the actual cash, which you can keep. So that free cash flow. Now, obviously, if you have a lot of cash flow, what's going to happen? Well, investors will be more sure, right, that you're going to have the money to actually pay the dividends, all right? And whether you like it or not, you're going to have more money to do what? Buybacks, authorizations. So more buying pressure on your own stock that they are holding. So they see a much better chance of the stock they're holding to be appreciating in the future, right? If you keep on expanding those capex, what's going to happen is that your free cash flow, it's going to cratering, right? And if you look at the projections, right, looks like they're going to turn negative. In the case of Google, this quarter, cash flow actually turned negative. 5.8, 5.9 billions. So, plus, you may also say, okay, but a lot of those earnings per share that they reported, a lot of that was due to the fact that they were holding a good chunk as an investment in SpaceX. SpaceX was a good IPO at the end of the day, at least initially, right? So they kind of register that capital gain. But if you strip APS out of that, maybe it's not that high as the initial report would make you think. Yeah, it's a legit argument, I guess. But, I guess most of the real story is in here. Now, look, the problem with, these capex, it's that we are kind of in a golden period, in a golden window now, because of how accounting gimmicks actually work, right? Because look, they are growing, right? APS at a very huge pace, above 20%. And you may say, okay, so then what? The stock is punished. Well, because at the end of the day, no matter what, you see the numbers there, they're all about 20%, which is good for now. But may just be, and I'm not talking in absolute terms, we'll still have to assess that in the future, but I think what the market is sniffing, it's what a very controversial figure and character talked about a few months ago, which is basically depreciation and amortization, right? When when an hyperscaler like Google or Meta or Amazon, when they buy a chip, right, what do? Well, they register an asset on the balance sheet, but the cost on the passive side of the balance sheet, it's postponed, right? And what the chip makers actually do, well, they register a revenue, right? So everyone wins initially in this golden window up until the point you see amortization and depreciation actually kick in. So this is explained even better than me in plain English, right? So they're spending 760 billions, but they are registering just 200 billions, right, in expenses. Because the rest is going to stay on the balance sheet waiting for what? Again, amortization and depreciation back down the line, right? So it becomes a drag on earnings just later on, right? So, if you see that these hyperscalers, they are seeing the cash flow projected to be, reduced by 91%, right? And yeah, I mean, they are gonna keep on growing earnings and revenues at 25%, sure. But at a point, that math, that doesn't add up, right? Because they will have, at a point, to register the impact of the deferred cost on their balance sheet, right? And it's like everything they are making now in terms of money, it's just getting out the door right away because they are spending all of what they gain in investments, in capital investments, in chips, in the build out of the infrastructure. So that's what's really getting to investors at a point, right? So, that's one side of the story, which would be the bearish side of the story. If you just look at the chart right in here, all right? And then what? The bullish side of it would be that in the coming years, right? So 2027, 28, whatever, they are going to see, yeah, sure, CapEx keep on growing nominally, all right? As you can see here, it goes up, 760 now, 820 then, 930. But you see that the pace, the percentage increase at which CapEx is still growing, it's going down. So they're kind of tapering the CapEx, but at the same time, they are expected to maintain the same level of EPS growth, around 20%. In that case, you would expect what? That free cash flow to kind of have a V-shaped type of recovery, right? So this is kind of the bet that the bulls would do on these type of build out. Yeah, maybe free cash flow is going to be impacted now, but if we just assume that they're going to keep on maintaining that same percentage of APS growth in the future, and they're going to taper a little bit those capex, I mean, free cash flow, it's not going to be a problem in 1 year or two. That's the bet. Problem is, again, that when you start to factor in amortization and depreciation of those assets they are buying, like, I mean, a GPU now, right? What type of usage or of life cycle would you put on a GPU? I mean, if NVIDIA keeps on releasing new and updated chips every 2 or 3 years, you buy a chip now, and in 2 or 3 years, they're going to come and saying, well, you know what, to develop those AI models, you need the best of the best now, which is what we got now. So you thought initially that you buy the chip now and it's going to be good for 5-6 years, and you put it on your balance sheet and you decided to amortize that for 5 years. Or you're going to use it for 5 years. Guess what? In 2 years, you're going to need a new model. So you're going to need to spend more money. And that depreciation is going to kick in way quicker than what you were expecting. And those amortization process, it's not going to be, spread out on a 5 years time span, but, you're either going to need to reduce that time span, or you're going to need to add on top of that amortization process a new one, because you need to buy a new chip, the greatest, the latest and best, So that's the risk in assuming that CapEx will be tapered, and at the same time, they will be able to maintain the same APS growth, all right? It's an assumption, sure, but there is a difference in assumptions and realities, right? So that's what the risk is for now, all right? Now, with all that being said, it looks like we are massively bearish on the Mag 7 and AI. Look, AI, it's gonna stay. I'm not saying it's not gonna stay. I'm just saying that probably expectations are a bit too much currently, right? So we may need to see those expectations to be, reevaluated, reassessed, and repriced potentially, right? I'm not saying you should go outside and sell all the big tech you got. If there's one thing that the past actually taught us, is that it's very hard to bet against those companies. Like take Google, since we're talking about Google. Remember back in the days, everyone was talking about, why the hell did they spend so much money to acquire YouTube? Who the fuck is gonna spend time watching videos on a PC or on a tablet or on a portable computer or whatever? I mean, it sounded reasonable when you were talking about it back then. Nowadays, I mean, if you just come up with that, you sound stupid as fuck. Because again, if there is one thing, at least over the past 30 years, these companies, the Google, the Amazons, right, the Microsoft, they have been very good capital allocators. Therefore, although you might say they're going to have temporary stumbles here and there, short, but over time, I think don't bet against them directly, just manage the risk of, short-term volatility or, short-term bumps that they can incur in, right? It's just that for me. I'm not saying I'm bearish big techs. I'm not saying you should go out and sell them all and never buy them back, And, to close in on a little bit of a much positive note, just to remember, right? No matter all you can think of, and no matter all the bearish spins you can hear people, myself included, to be put on these companies, just remember these. Over time, the market goes up. It goes up, whether when, EPS are growing, sure. And incredibly, even when EPS are negative, the market still find reasons to go up. So, at the end of the day, the majority of the time, this is why you see, you have the good old saying, stonks only go up, because of that. The only one problem with that is that when they go down sharply. And one downturn, especially if you panic out or if you are massively leveraged, it could erase years of gains. So the only one thing, again, is always to manage your risk. Just need to take care of the downside. The upside will take care of itself over time, right? So that would be kind of it for these, story about Google disappointing earnings, and even Tesla. Tesla, atrocious chart, at least in the short term, right? And again, even Elon Musk is a guy which I said many bad things, right, about SPX, but it was coming out, and for good reasons. I mean, at the end of the day, I wasn't saying that you shouldn't ever considering buying the companies. I was just saying, look, this IPO is a bit fishy, it's a bit sketchy. Turns out, 1 month later, we are where? 25% below the IPO price, the initial price which was traded. So I'm not saying you should never ever buy a SpaceX, but I'm just saying it wasn't a good buy at the IPO. Maybe in the future, who knows? This chart, it's too young. We don't basically have price action in here, right? But 2027, I would say, first of all, at least let's wait for the first quarterly earning call and see what they say, see if they're making money or not, right? We'll see what the guidance is, right? But, again, at the IPO, it wasn't good. But then again, I also said it's very hard to bet against Elon Musk, because if you think about all the things he did in the past, from PayPal to Tesla. No matter what you think about the character or about the individual, the human being, he's been very good in creating value and making money for the shareholders, one way or the other. And again, you don't have to love him, you don't have to hate him. But numbers are numbers. And again, if you, getting back to Tesla, if you put money with him, Tesla was trading around what, 13, 14, 15, and then it got up to 150 at a point. So you can't say he didn't create money for you if you were investing in his own company, right? So again, always differentiate your personal opinions on other human beings to what financial markets results may be, right? Other than that, we were looking this one, so the potential flip in relative strength in between MAGS and momentum, nothing. I mean, it just lasted for what, 1 week, and then we are back below the 50 days moving average. And if you look, the blue line, so MAGS, crossed back below the green line, which is momentum. So, they're both coming down. It's just that MAG 7 are coming down faster than momentum stocks. The good thing is that if you look at these, and I'm going to remind you that in red, you have NDX, so the NASDAQ index. In black, you have the SPX, so S&P index. In blue, you have the RSP, so the equal weighted S&P 500 index. So if you see again, the equal weighted RSP being relatively stable and, kind of maintaining these distance from the highs, while the rest it's dropping. What does it mean? It means the breadth is actually improving, which again, although it may not seem like a good news considering where the indices are actually going. I mean, at the end of the day, for now, it just tells you that the sell-off, if you want to call it that, it's not generalized. It's more of a big tech mega cap story. And again, it could be because of the earnings calls, the capex, free cash flow, yada, yada, right? But other companies are actually, at least doing good for now or holding in, right? Hanging in there. It kind of look a bit more, instead of the classic growth to value rotations that we have seen so far, right, in recent times, it looks a bit more like massively in favor to massively out of favor type of rotation. You get money out of what was pretty much extended and performing very, very good, and rebalancing things out into something which up until this point performed a little bit less or, way worse, right? As for the VIX, since I have it in here, 18, not really going anywhere for now, which again, it's strange, right? In, a week, but basically all the semiconductors, let me see on a weekly time base. Yeah, I mean, on a week where semiconductors were negative, and, the MAX 7, so the huge bulk of the market capitalization weighted index are going down. I mean, you would have expected the VIX to be a bit more, to the upside. Instead, no, not for now. I'm not saying you should sell volatility here, but still, two things. Either the market is not worried, or there is a bit more downside, which would leave a little bit more space for the VIX to come up, right? We'll see about that, okay? As for the rest, what else do we have? Wanted to talk about that tiny little thing there. But before we do, just, for the sake of it, and generally speaking, since we have been talking about, breadth, the VIX, let's have a look at these two things first. Now, this is basically, they call it the undertow. That chart in here basically tells you what happens when the index is moving one direction and how the breadth moved in the opposite direction. Sorry about that. And it looks like, this year we are looking at that phenomenon many times compared to the past, aka the index moving one direction, but the majority of the stocks in it moving in the opposite direction, right? Which again, it tells you that there have been a lot of breadth divergences, all right? Then what? I mean, again, always onto the subject of these divergences and volatility being relatively tame. I'm going to bring back a chart which I posted like I think 2 weeks ago, something like it. The implied correlation, which is very low for now. And again, it's just a testimony of this. The index goes one way, the rest of the stocks in it going the other way. So the implied correlation, it's very low. What happens if all of a sudden this implied correlation actually bounces? Just when the VIX maybe spikes to the upside, all the stocks, or the majority of them in the index, will start to move in the same direction this time. And with the VIX spiking, usually it's not to the upside. So that's another risk, all right? Another dynamic which could add fuel to the risk, so to speak, right? Speaking of volatility, from a seasonality standpoint, as we see, we are in July, so very low volatility month, actually one of the lowest. And again, look, for the month of July, the market didn't move a lot, right? But now we are entering in what? Well, August, September, a bit more volatility ahead. Again, volatility is direction neutral, doesn't tell anything about direction. It just tells, about the dispersion of returns, right? So, market which could be a little bit more nervous, right? Like for instance, just again, since it is direction neutral, we do know from a seasonality standpoint, Q4, so October, November, and December, to a lesser degree, are the best months of the year. Volatility is particularly high in those months, right? And it's usually to the upside. Although it starts to be relatively high, above 10%, even in August, September, but we do know those are the worst performing months of the year, seasonally adjusted base, right? So again, it's direction neutral. It just tells you what type of moves you can expect, right? And again, another way of saying the same thing, especially, we're going to have the midterm election, which could, again, bring in a bit more volatility, but it's just represented a different way in a measure of these bands being wider or tighter that I would, describe the volatility to be expected, right? Then what we got, I think, again, this is Goldman prime book. A lot of people sold tech. So again, this may be a little bit of a contrarian signal. Like a lot of people selling. The narrative is starting to be particularly bearish. The hyperscalers, they're not gonna deliver, right? The AI build out will be, a failure in the end. Oh, not to mention, I think this week, I think it was called Moonshot, a Chinese company, released a new AI model. I think it's called Kimi K3, something like that. You can Google that out. And, it scored very good numbers in benchmark. So again, do you remember the DeepSeek moment a year back? Now we may have the Moonshot moment, right? Which again is always a risk, right? So look how many things you would need to follow in order to explain why the stock market moved one way or the other with just one simple week, right? I mean, there are a lot of things to factor in. It's not always easy, which is why at the end of the day, I do prefer technical analysis, right? Like, I mean, did I know that earnings would have been this way? Free cash flow would have been this way, or the Chinese would have released another AI model, very competitive, very efficient? No. But did I know that I should have expected potential weakness getting into the summer? Yes. I started to know that and to say that in March. So I guess, stats and technical analysis for me, since I can't humanly keep up with all these data and things to keep on looking for. Why? But it's way easier for me to just look at a chart and a few indicators, right? That's just me. Maybe you are you're way better than me and you're way smarter than me, but I'm not. So, you know, that's it, right? So on top of it, we got a lot of insiders actually selling in the first half of the year. Now, again, what's an insider in this case? When you hear the word insider, you always think about insider trading. It's not necessarily that. It could be that, obviously, but insiders could also be an inclusive term to refer to like even workers, right? If you have a job at Amazon or Google or Tesla or Apple, maybe a portion of your compensation, of your salary, it's made out of stock. So since you have, you know, the ability to have a glimpse of what's going on inside the company, you may say, you know what, instead of keeping those stock options, I'm going to sell them, right? It's not a good sign, right? If insiders are selling, it seems to say like, I mean, we work in here, we see that things may not be as they seem to the outside world, and we decide to liquidate our stocks and get the money. Because if we thought the company is going so well that the stock is going to be up another 20-30% over the next 2-3 years, well, of course, we're going to hold on to them, right? So, you know, that could be a thing. All right. And then, you know, the last part of the video, I'm going to move to that now before closing in. And it is about bubbles and the relevancy of bubbles. So about bubbles, first of all, I mean, you've heard a lot about, are we in a bubble? Is the AI industry in a bubble or not? My answer has always been maybe, I mean, but does it really make a difference? So first of all, if you think about a bubble in and of itself, what it could resemble, we have a few examples, even in recent times, like for instance, this is Bitcoin, right? And you see what happens when you start to have, you know, kind of like bubbling behaviors. They're always followed by what? A prolonged period of a pullback, or, you know, you may call it a crash, right? And it goes for Bitcoin at, you know, different stages in its very short life so far. But it also goes for something like gold, right? It started to be very bubbly and then a lot of volatility at the top. And it came all the way back down from 5,600 back down to 4,000 for now. Same for silver, right? It seemed unstoppable at 120 and it's now, you know, below 60. So more than a 50% drawdown. But, you know, you could apply the same thing to many different things, like even the stock market in the past. If you remember, like the .com, and look at how much we kind of drew back, right? And, you know, so are we in a bubble now? I mean, the most recent example of what could resemble a bubble bursting, it's the Kospi, so the Korean Composite Stock Market Index, which, if you look at it on a weekly time frame, it went all the way back up, and then it started to completely melt down. Not to mention that, you know, people actually put money in this thing right here. So basically a 3x leveraged ETF on, you know, the same Korean stock market. And obviously results are what they are when you start to have the reversion of margin debt, and therefore you start to have margin calls and all the rest. But my point is different in this case. Like if we look at this, for instance, right, we can see many different bubbles of the past, starting, you know, from, you know, the railroads, the Nifty 50, then you had war, Japan, the TMT, technology, media and telecommunication, I guess, which is basically the .com, right? And now do we have the same with AI? Maybe, potentially. And what usually happens after those huge run up, it's a good amount of drawdown. Now, here they are including the tulip mania, kind of like the first bubble, the historical bubble. But I mean, you know, the usual type of drawback is always kind of the same. It's above the 50%, right? I mean, other bubbles kind of explaining or, you know, displayed in a different visual, but it's kind of the same, right? What goes up sharply, sooner or later comes back down sharply. But my point is a little bit different. Are we in a bubble now? Let's look at this comparison, for instance, right? Now, I'm not going to read it all, but as you can observe by just looking at the verdict, right, there are a few characteristics of this current market environment which could resemble bubbling behavior, but there are a lot of them which are still better than what you would expect in a real bubble. Now, in this case, obviously, they are just considering the .com, right? So they are comparing the situation now to what it was in the 2000, right? So, I mean, you could say maybe we are in a bubble, but maybe it's not so close to actually, popping. Now, another point would be for me, look, the point of a bubble is that it's identifiable and definable only and always in hindsight. Because think about the psychological dynamic in there. If everyone would convince that we are in a bubble, right? What do you think they will do? Wait, we are in a bubble. I don't want to be left hanging, holding the bags. I'm going to sell it now. Okay, if everyone can see that and everyone can think we are in a bubble, everyone is going to sell. And the bubble won't even form, right? Or at least, it's going to pop before even going ballistic, all right? So that's another thing, right? At the end of the day, though, the point I wanted to make, and I guess, it's going to be real quick at this point, is that it's futile to try to understand or to identify a bubble. And we have many different examples from the past. But, I just screenshotted a paragraph. Like a good example, right, of the futility of spotting a bubble is Alan Greenspan. 1996, the proliferation of instruments, the irrational exuberance, and then, the bubble actually popped when? In 2000, 4 years later, right? Then you have even Stanley Druckenmiller, right? Which, by the way, worked alongside George Soros. They identified the Japanese bubble in 88, and they shorted it. And the Nikkei, what did the Nikkei do? It kept on ripping higher for another year, and something more. So, lesson there was valuation is not a catalyst. It's just a warning sign, maybe, but it's not a catalyst, right? So bubbles are basically held up together by what? By narratives. And again, as I was hinting at in previously, everyone thought the internet was revolutionary, and it, that justified companies like Cisco having a PE ratio above 100. Everyone was thinking Japan was unstoppable up until the point it wasn't. And in 2007, everyone was thinking, the housing market, it's never going to crash, because if you ever seen The Big Short, the movie, who doesn't pay the mortgage, right? And then you got adjustable rates kicking in and, all the subprime shit coming back down. So it's always about complacency. It's always about being convinced that something will never happen. And always getting back to the movie. If you remember the quote at the beginning of the movie, I think it's from Mark Twain. And it goes, I don't remember the exact words, but it was along the lines of, it's not what you don't know which puts you into trouble. It's what you think, it's what you know to be for sure, and it just ain't so, right? So if you're aware that you don't know something, logically, you're going to be a little bit more defensive, right? When you approach something you don't know, you're always a little bit careful with it. But when you are convinced that something is the way you think it is, and you don't have any reasons to doubt what you think it's valid or it's justified or it's true, that's where you basically abandon all the type of risk management and you start to take things for granted. All right. So that's why and how bubbles actually form, right? It's before being a market dynamic, before being a liquidity dynamic, before being a credit dynamic, it's a psychological dynamic, right? Now, the point will also be, if you look at a few signs that you could look for in order to kind of spot if we are very near a cycle end or potentially a bubble bursting, it's looking at these 4 things, right? Like, flood of new stocks issuance. And again, a few examples in here. Right now, you could think about what? I don't know, SpaceX, and then ChatGPT, aka OpenAI, and then maybe Anthropic, actually applying for going public. So a lot of share offering on the open market. Market participants' behavior shifting from buying the dip in buying the rip. It's like, for now, I think we are still in the buy the dip. Like the market pulls back a bit, I'm going to buy the dip. But when you see people actually starting to buy the breakout, the market is going up, it breaks a high, I need to buy now. That's FOMO, right? That's another behavioral index that something is changing. It's getting to extremes. Of course, the financial coverage, the mainstream, the narrative. When everyone when everyone stop even questioning if we are in a bubble, that's the most dangerous time, right? So again, it's counterintuitive because to some degree, everyone would agree on the fact that it's very useful to know if we are in a bubble or not, so that I can take, preliminary measures. On the other side, if you know it, it's not going to happen, all right? So, I think at the end of the day, the most important aspect when it comes down to assessing whether we are near or not something which could pop a bubble, it's always a credit-related event, right? Because what is fueling bubbles? Money. What is money? Liquidity. How do you get liquidity? You need more money. You need more funds. How do you acquire them? What is money? Money is credit. What's the other side of credit? Debt. Because we live in a debt-based system. So when something impaired, that mechanism by which you can create new credit, extended new credit, creating new money, when something impairs that, that's when you got liquidity issues. And liquidity is basically the fuel which keeps the bubble running and popping and getting bigger and bigger. So when you stop having that, it's kind of game over. And on top of it, you add all that margin debt, which was taken on, which now needs to be unwound. The process starts to reverse itself, and that's how you have bubble actually bursting themselves. But again, one thing it's saying, well, you know what, I think we are in a bubble. Okay, so what? If you are in a bubble, or if you think you are, does it really matter? If the rest of the market is not aware, they will keep on behaving the same. And again, Greenspan, in 1995, 1996, irrational exuberance. Do you sell it all in 1996? And the market goes another 200% up until 2000? You would have left a lot on the table. That's the controversy about bubbles. So, I think if you look at the whole thing through the lenses of the credit market, for now, although we may or may be not in a bubble, the credit market, it's not actually picking it up. It could be that, 6 months, 1 year down the road, they will start to pick it up, maybe. But for now, they're not. So it's one of those things where it's just like a game of musical chairs, right? That at a point, someone will start to take away the chairs and the music will eventually stop. But up until the point it doesn't, your best chance is to stay as close as you can to those chairs to make sure, and when the music stops, you still have one to sit on. Or, it could be, like you are at a party. Yeah, you keep dancing because everyone is still dancing. But maybe, every single time you take a one step closer to the door so that when the music stops and everyone needs to stop dancing and actually reach for the door, you are on the front line rather than on the back of the line. Right? I think that's the only defensive mechanism against, a bubble behavior in markets. And, at the end of the day, there are many different quotes from the past. Like the market can stay irrational way longer than you could be solvent, right? Sure, they are all true, obviously. But there is not a lot you can do in order to time a bubble, right? Like, even Michael Burry, yeah, he got famous to identify and call the 2008 financial crisis. Sure, it was too good. It was so ahead of times. It was so smarter compared to anyone else that he almost got bust because he went short the market way too early, and the market kept on being irrational for another 2 years before finally popping in August, September 2008. Was he smart? Yeah. Was he right? Yeah. Did he almost go bankrupt? Yeah. So sometimes, right, you don't just need to be smart, but you also need to be lucky with the timing more often than not, right? So again, everything seems bubbling. Yeah, sure. Is it going to stop tomorrow? Don't think so, right? So always remember that, right? No matter what people say, no matter what you read in the media, and again, the way, or the day this bubble will burst, you would probably know, or at least you would know that something is starting to change, both in the price behavior and in behavior of market participants, because if you live in the US, you may wake up one morning and you would notice that the market is down 5% overnight. That's the day when you immediately de-risk and think about things later, because it's not normal, right? It means that something must have happened. Whether the actual bubble burst, or whether the yen carry trade blew out, whether we have some incredible geopolitical event which could act as a catalyst for a market which is already bubbling to actually finally popping, But up until you see something like that, it's really hard to say, well, you know what, I know when to get out. Yeah, it's easy to say in hindsight. When you live in the moment, you're never gonna know. It's like what Mark Douglas used to say. Every moment in the market is unique. They're all similar at the end of the day, but they're all unique in their own way. So just because you read a book, you've seen a few charts from the past, that doesn't necessarily mean that you're going to be able to identify the same or similar things playing out in a similar way in real time, right? That's such is the nature of a black swan event, right? And since we have hinted at the fact that what could actually burst the bubble is a credit-related event, because before I leave you off, I'm going to suggest to you, since we have hinted at private credit, which is not a problem for now, maybe, but it could be in the future. What's the scale of it? What's the magnitude of it? What's the contagion risk? I would suggest you to watch these podcasts right here. I think it came out 5 days ago. It's hosted by Jack Farley at the Monetary Matters. It was really interesting, especially if you are a little bit into accounting, dynamics and whatnot. It's not about charts. You're not going to see charts, moving averages, indicators and what, but it's really interesting as the guy in here, it lays out the dynamic of how this potential bubble we are living in right now, it is structured and what could actually pop it. And guess what? Doesn't come from AI, doesn't come from hyperscaler capex, it doesn't come from China developing a new model which is way more efficient or cheaper. It comes from the inside, as is often the case. Which, again, doesn't mean it's going to have to happen tomorrow. As for Michael Burry, he identified the problem correctly, but the market kept on going for another 2 years, right? Before that problem actually manifested itself and became visible and, evident for everyone else in markets, right? So, if you have time, give it a listen. It was a very good one. A bit boring maybe at times, especially if you're not particularly familiar with accounting, balance sheet constructions and whatnot, but the point sticks, right? And with that, I'm going to leave you off for the week. I'm going to wish you a very good weekend. And next week, remember, we're going to have FOMC, so markets may be a little bit more volatile, right? Especially around those times. So be sharp, be careful, don't lose your head, right? With that being said, as usual, be nice and be cool. Needs out.
How much is enough, Gordon?
The richest 1% of this country owns half our country's wealth, $5 trillion. 1/3 of that comes from hard work. 2/3 comes from an inheritance, interest on interest accumulating to widows and idiot sons. And what I do, stock and real estate speculation. It's bullshit. You got 90% of the American public out there with little or no net worth. I create nothing. I own. We make the rules, pal. The news, war, peace, famine, upheaval, the price of a paper clip. We pick that rabbit out of the hat while everybody sits out there wondering how the hell we did it.